Right, we're in Module 3 and we're going to go through a bit of a walkthrough. We've got some transactions to record and we're going to record them to the T accounts. So in this video, it's going to be a bit of a longer walkthrough going through the T accounts. Now, you'll see there that I've put the accounting equation just at the top as a reminder, and I've also got my debit credit table up here as well. So, assets and expenses are going up, then we're going to need a debit. Assets and expenses going down, you're going to need a credit, and the inverse applies to the other side. So, we're going to be doing a bit of a walkthrough. Now, there's going to be 3 phases when you go through the T accounts. First of all, we want to record opening balances. So, an opening balance is the balance of something at the start of a period. Maybe that's the start of the month, or maybe that's the start of a year. Either way, that is the opening balance. Stage 2, phase 2, is we record the transactions. We record what's happening and the debits and credits associated with that. And finally, we calculate the closing balances. Closing balances are the balances at the end of a month or at the end of a year. And you'll soon see that the closing balances are actually quite useful because we use them to actually prepare financial statements. So that's getting into a bit of Module 4, but just know that they are used a lot. Okay, so 3 phases. So let's get into the little walkthrough. Okay, we're going to do phase 1, and we've got some opening balances. So 1st of January, we've got opening balance for bank account. So what account's involved, what element, and is it normally a debit and credit? So bank account, $4,000. Well, bank account's easy. Bank account is an asset. So an asset is normally a debit. So we put that $4,000 here. Now we need to record a few details. Hopefully you can see a little bit of this on screen, but I'll read it out. We want to put the date. And in the details, I've written opening balance, or OPBAL for short. And that's recorded our balance of the bank account, $4,000. Now we've got 2 more opening balances. We've got some assets that we have, some equipment, and we've got some capital. So again, you need to identify, well, what are the things involved here? So equipment, $16,000. So again, equipment, something that you own, that you're going to keep for a long time. So we need a brand new T account for this. So each item has a brand new T account. Different account name, different account, T account. So equipment, $16,000. Then the next part is we need to record capital. So the owner has introduced some of that money. So I'll do a new T account up here. Now, capital is a bit different. Owner's equity is normally on the right-hand side. So we record this on the right. There we go. So now our accounting equation is in balance. If we total up the left-hand side, $20,000. If we total up the right-hand side, again, $20,000. So the accounting equation is in balance, debits equal credits. So we've just done phase 1. We've just done our opening balances. So yeah, do debits equal credits. Left-hand side equals right-hand side, and that's the normal side things are. So assets and expenses are normally debit. Liabilities, owner's equity revenue, they're normally credit. Got the debit and credit table up there. We're going to be using that now for the transactions. So, transaction number 1, 2nd of January, the owner contributes another $35,000 to the business. Excuse me. We need to identify the 2 accounts involved. So, what are the 2 accounts involved? Which of the elements are these? they increasing or decreasing? And are they a debit or credit? Okay, so owner contributes $35,000 to the business. So again, this is always the business perspective. Business bank account is going to be affected. So owners put money into the business bank account. So the business bank account, that's an asset, we know that. That's going to increase. So asset, the business asset going up, that's going to be a debit. So $35,000. Thank you very much. On the 2nd of January. I'll just leave the details field short, field not filled in just yet. The other account as well, the money is coming from the owner. So money coming from the owner, that's going to be capital, money coming into the business. So 2nd of January, $35,000, because owner's equity, or the owner's share, has gone up, so we need a credit. Okay, so we put in the money figures and the date, now the details. For details, now we get into cross-referencing. So whatever the two account involves are, what you do is you swap the names and put that in the details field. So in the bank account, you go, okay, swap it. Capital, you put capital here. So that says that in the bank account, the money came from the owner. It came from capital. And here, again, you swap it. Well, capital means, okay, money introduced, the owner introduced some money into the bank, into the business. How did he do it? Well, he used the bank account. So remember to cross-reference. Cross-reference whatever the two accounts involved, put the opposite name in the details field. Okay, so that has just done one transaction. Oh yes, and I've put there how it looks. So note the cross-referencing on the account names. Okay, got some more transactions here. Pardon me. 3rd of January, we purchased a vehicle for $10,000 cash. Right, similar to what we did in Module 2, purchase a vehicle for $10,000 cash. Well, bank account's going to be affected, isn't it? We're going to use money out of the bank account. Bank balance has gone down, so this will be on the credit side. $10,000. Now, vehicle is also affected, so we need to record that we now have a vehicle. So, vehicle has gone up. We didn't have one before, so now we do. $10,000. And again, cross-reference. So in the vehicle, how did we pay for it? Well, we pay for it with the bank account. And the bank T account, again, where did we spend the money? Well, we spent it on a vehicle. So it's quite helpful showing how we spent the money, or where the money came from. Okay, 4th of January, we paid interest on a loan, $150 cash. So we paid, okay? The word paid is in there. So again, bank account is affected. So money is going to come out of the bank account, $150. Then we need to think about, well, what's the other account involved? So 4th of January, we paid interest on a loan. All right, $150 cash. So this is going to be a new T account called interest paid. Interest paid, that's an expense item. So, cost of the business, well, yes, the costs are going up. So, expense going up, it needs to be on the debit side. Which is good, because debit here, credit here. And now cross-reference. So here, how did we pay it? Well, we paid using the bank account. What did we spend the money on? Well, that was interest paid. Okay. So that's recorded that transaction, interest paid on loan. Finally, 5th of January, we had cash sales of $5,000. So now we get to record we've received some money from customers. Cash sale, great, goes into the bank account. 5th of the 1, just going to record, yes, it's a sale, $5,000. Now we need a new T account for sales. Again, we need to think, what element is it? It's revenue, it's money coming from the customers. So revenue, has it gone up or down? Well, it's gone up, we've earned more money. Yes, we're on the credit side. So 5th of 1, we've made cash sales that have gone to the bank. And that's $5,000. So again, always go back to these questions. What are the two accounts involved? What element are these accounts? Are they increasing or decreasing? That way we can use the debit credit table and record the debit or credit. When you record the debit or credit, remember to record those three parts: date, details, amount, and cross-reference the field. Right, we have done phase 2, recorded the transactions. So it gets into phase 3, balancing a T account ledger. So we have all these accounts here, and we've got transactions in each of them. Now at the end, we can find out, well, what's the end balance of each item? So here's a few little tips. Now to balance up an account that just has transactions on one side, well, you just add up that one side and that will give you the balance. So here this is an example of the capital account. We started with 20,000, he added 35,000, so the balance is just simply 55,000. So you can write closing balance or balance 55. Now note, this is a balance on the right hand side, so this will be a credit balance. When we start looking at things like here, equipment, well, and on this side, this is going to be $16,000, and that's going to be a debit balance. Likewise with vehicle, easy, that's 10,000. Interest paid, that's 150. These are all debits. So it's easy when there's just one thing on one side. You just add it up, that's your balance. Okay, things get a bit harder when you have things on both sides. So our bank account is the one example of that. To find the balance, you take the larger side and you subtract the smaller side. And the balance is the balance still on that larger side. So here is our example of the bank. We have 44,000 on one side, so that's on the debit side. We then paid out 10,000 and 10,150 on the credit side. So that leaves us with a balance of $33,850. So that's the amount of cash that we had in the bank, and so that's $33,850 debit. Okay, so that there is the balance of all the accounts. Okay, I'll just flick back to the bank one. This is going to be the hardest one that you come across, but this is how to calculate a bank balance. Now, last step is do the debits equal the credits. If you've done this right, hopefully, the total of all the balances will equal. So, what's all the balances of the accounts we've used? Now, I've got an example on screen here. You just take all the accounts and take the final balance. So for bank, 33,850, equipment, 16,000, vehicle, 10,000, sales, that's a credit, so that's 5,000, interest paid, that's 150, and then capital is 55. What we do is we add up the total of all of these. And the total of the debits is 60,000, and the total of the credits is 60,000 as well, which I'm very glad it is, because it means we've recorded all the transactions correctly. Now you learn in a later part that this is actually called a trial balance. A trial balance just goes through and helps you figure out where that all the debits equal the credits and lays it all out ready for the financial statements. Okay, so that's been the walkthrough. So we've gone through the 3 phases. We've recorded opening balances, we've recorded transactions, the debits and credits, and then we've recorded the closing balances. And then finally, we've tallied up all the final balances to make sure our debits equal our credits.